Right now, the financial media is celebrating what looks like an AI gold rush, but almost nobody is talking about what may be happening behind the scenes. If you've been watching your retirement account, pension fund, or index fund rise because of tech stocks, you probably assume those gains are being driven by real customer demand. But that may not be the full story. What you're about to hear rarely gets discussed on financial television because the biggest players in the market benefit from keeping attention elsewhere. The reality is that a huge amount of money flowing into AI may not be coming from natural business demand at all. Instead, it could be part of a giant financial loop that makes growth appear much stronger than it really is. This isn't simply a story about revolutionary technology changing the world overnight. It's also a story about how large cloud companies can use investment money to create the appearance of explosive growth at a time when many of their traditional businesses are slowing down. And if your money is invested in the S&P 500 or other broad market funds, you're already connected to this system, whether you realize it or not. To understand how this works, we first need to look at how modern venture capital and cloud computing operate. Most analysts would have you believe that AI companies are generating billions because businesses everywhere are rushing to adopt artificial intelligence. But that explanation starts to fall apart when you look at what it actually costs to build advanced AI models. Training large language models requires enormous computing power. AI startups need access to thousands of expensive graphics processors and massive data centers. Without that infrastructure, they simply cannot compete. And this is where the cycle begins. Meet Bob. Bob runs a brand new AI company that suddenly receives a $10 billion investment from a giant technology company we'll call Megacorp. News headlines celebrate the investment as proof that AI is the future. Investors get excited. Analysts raise their forecasts. But there's an important detail buried in the agreement. Bob doesn't just receive $10 billion and spend it however he wants. A large portion of that money is expected to be spent renting cloud services and computing power directly from Megacorp. So, the money leaves Megacorp's balance sheet as an investment, passes through Bob's startup, and then quickly returns to Megacorp in the form of cloud revenue. The cash technically moves, but it never really leaves the ecosystem. Financial experts often refer to arrangements like this as a round-trip capital loop. The company invests money into an AI startup and then receives much of that same money back through service contracts. On paper, the results can look impressive. Megacorp reports growing cloud revenue, investors see strong numbers, analysts describe the business as booming. Yet some of that growth may have originated from capital that Megacorp provided in the first place. Later, we'll examine public filings and disclosures that suggest this process may be taking place on a massive scale. But first, we need to understand why the effects extend far beyond corporate earnings reports. The real impact appears when these reported growth numbers influence stock prices. When Megacorp announces strong revenue growth, investors often bid up the stock. As the company's value rises, index funds and ETFs automatically increase their holdings because their rules require them to follow market capitalization. That means millions of ordinary investors may end up buying more shares without ever making a conscious decision. The cycle then feeds itself. Large tech companies invest in AI startups. Those startups spend heavily on cloud infrastructure. Cloud revenue rises. Stock prices climb. Index funds buy more shares. Rising valuations create even more enthusiasm for new investments. From the outside, it looks like unstoppable growth, but critics argue that much of the momentum may be coming from a financial loop that continually reinforces itself, creating the appearance of demand that is far larger than it would otherwise be. And as long as investors keep believing the growth story, the machine keeps running.